Hi, I'm Bob Jaswinski. Welcome to our July 2015 review of the markets and economy. Returns for the quarter ended June 30th were generally slightly positive for stocks but negative for bonds. For the 6 months ended June 30th, the S&P 500 index reflected a return of 1.2%. The return of the S&P 500 index, representing United States large company stocks, was generally exceeded by United States small company stocks and stocks of foreign developed and emerging markets. This chart shows the returns for representative indexes of our globally diversified portfolios. The Russell 2000 index for United States small company stocks reflected a return of 4.8%. The MSCI EAFE index for foreign developed stock markets reflected a return of 5.5%, and the MSCI EME index for emerging markets reflected a return of 2.9%. Our blended index, reflecting the weights of the various stock asset classes we use in our globally diversified strategies, reflected a return of 3.2% for the 6 months. This return is not annualized, so an annualized return would approximate 6.5%. Based on how global equities markets are priced and prospects for global economic growth, we believe that high single-digit returns, on average, are likely over the next 3 to 5 years. We also think it is likely that foreign developed and emerging markets will outperform the United States over that time period. In looking at the entire chart, the best performing stock asset class is highlighted in yellow. For year-to-date 2015, foreign developed markets were the best performing asset class used in our diversified strategies. One of the benefits of broadly diversified strategies is that the leadership of the best performing asset class changes over time. That has the effect of producing lower overall portfolio volatility. The headline news over the last few weeks and months has been the evolving story of Greece. This chart shows that the risk premium of Greek sovereign debt has been increasing and is very high, perhaps reflecting negative expectations on the part of investors investing in Greek bonds. The right side of the chart shows the impact of fiscal austerity over the 2011 to 2014 time period and the expected effect over the next 3 years. Greece has made significant progress in reducing its deficit as a percentage of its gross domestic product. Whether or not Greece can survive without additional restructuring is a big question and is likely to weigh heavily on global markets for an extended period of time. For now, though, it appears that short-term solutions are in place to allow more time to achieve acceptable longer-term solutions. The 4 sectors of the United States economy that are significant in leading us into and bringing us out of recession are highlighted on this chart. Vehicle sales, housing starts, and business investment, reflected by real capital goods orders, all appear to be in stages of cycles that should prompt continued economic growth. There appears to be a lot of pent-up demand in housing, which should result in increased housing starts. Business investment is likely to continue to grow as unemployment and underemployment decline. The next chart shows purchasing managers' indexes for manufacturing throughout the world. The global index at 51 is in expansion. An index greater than 50 indicates expansion and less than 50 contraction. Although global economies are a mixed bag, most developed markets are expanding. The last chart I want to share with you this quarter is this chart on interest rates. There is much speculation that the Federal Reserve will increase the federal funds rate beginning in September. Market expectations are for more gradual increases than the Federal Reserve Board of Governors are currently forecasting. When the Fed does begin to increase interest rates, it will be the result of a strengthening economy and labor market. It is unlikely that increases in rates from currently low levels will result in the economy slowing down, as it does when rates are increased from much higher levels than they currently are. Although our message continues to be optimistic, We are paying very close attention to continuing developments in the financial markets and global economy. As we monitor developments, we will update you on any changes in our views. Thank you. I appreciate your taking the time to watch this video and urge you to contact me or your lead advisor if you have questions or desire additional information.